All right, so let's get into this. Every once in a while, you come across something, in this case an investment, that just completely forces you to rethink a belief you held for a long, long time. And that's exactly what this explainer is about. It's a story of going from total skepticism to being a full-on believer in a high-yield ETF called JEPQ.
Yeah, that was my first take. My unfiltered gut reaction to the JPMorgan Nasdaq Equity Premium Income ETF. Pretty blunt, right? But it came from seeing so many similar products just fail over the years. It's the kind of gut check a lot of us have when we see something that looks too good to be true. And then, this. 3 little words that changed the entire story. That initial gut reaction, that confidence that I knew exactly what this was, well, it turns out it was dead wrong.
What I think is so important here is actually admitting when you're wrong. This is basically a public confession. I totally underestimated JEPQ. It promised this gigantic yield, and against all my expectations, it actually delivered without destroying your initial investment in the process.
So let's make it official. The star of the show today is JEPQ. The goal is simple. Generate a ton of monthly income from a portfolio of those big-name Nasdaq 100 stocks. The tech and growth giants. But the real story, the part that matters, is how it manages to pull this off without falling into the same old traps as all the others. Okay, so to really get why this is such a big deal, you have to understand why I was so skeptical to begin with. So let's break down the 3 main reasons I initially wrote this thing off as just another trap.
First, there's what I call covered call PTSD. I'm only kind of joking. I've just been burned by seeing other funds use this strategy of selling away future growth for income today, and it usually ends badly. Then you've got that classic investor rule. If a yield looks that good, it's probably a trap. And finally, trying to do this with volatile growth stocks, it just seemed like a recipe for disaster.
And the ghost in the machine here, the fund that was haunting this whole analysis, was QYLD. Now, QYLD is famous for mailing out these huge monthly checks. The problem? It did it by slowly eating away at its own value, its net asset value, or NAV. So my assumption was simple. JEPQ was just QYLD 2.0. Same story, different ticker.
But then, the numbers came in. And this is where my whole theory didn't just get a crack in it, it completely shattered. The hard data told a story that was the polar opposite of what I expected.
My biggest fear was that capital erosion, that NAV bleed. I expected a dumpster fire, but it just never happened. While QYLD's value slowly dripped away, JPQ's NAV held remarkably steady. The capital was preserved, and while it was protecting the principal, it was also kicking off this massive, consistent yield. We're talking a payout that's just been hanging out between 10 and 12%. That's not a gimmick. For an income investor, that's real, reliable cash flow. And here's the final nail in the coffin for that old bias, the total return. When you combine the stable price with those huge dividends, JPQ has just blown its peers out of the water. It wasn't just paying you more income, it was delivering a way better overall investment.
So this just begs the question, how? How is this possible? If it looks so similar to other covered call funds, why isn't it failing like they did? It's time to pop the hood and take a look at JPQ's secret sauce.
The strategy is basically a 3-part dance. 1. It starts by just holding a bunch of big Nasdaq 100 stocks. 3. It ends by paying out all that income to shareholders like us every month. But the magic, the whole game changer, is in step 2. Instead of using old-school covered calls, it uses a much more sophisticated tool called equity-linked notes, ELNs.
So what in the world is an ELN? Don't worry about the jargon. Just think of it as a smarter, more flexible toolkit. It lets the actual human fund managers at JPMorgan adapt their strategy to what the market is doing right now. They aren't locked into some rigid, automatic formula that got the older funds into so much trouble.
And that is the absolute crucial point. JPQ is not some passive robot just blindly selling options. It's the institutional brainpower of JPMorgan, their decades of expertise in this complex world, all packaged neatly into an ETF. That JPMorgan factor, that's the secret sauce I so easily underestimated.
Okay, so the data is undeniable, and the mechanics are clearly different. That means it's time for a complete reevaluation. What's the new verdict on JEPQ, and where does it actually belong in an investor's portfolio?
What's really cool is how versatile it is. For a retiree, this can be a core income generator, a cash machine spitting out money every month. For a younger investor, it can be a yield booster that just juices up the overall return of their whole portfolio. It can even act as a diversifier, a kind of volatility buffer that smooths out the ride.
But look, there is no free lunch in investing. There are always trade-offs. With JEPQ, your upside is capped. When the market is absolutely roaring, you won't capture all of those gains. The income is also taxed as ordinary income, which is less efficient. And the whole thing works best when there's market volatility. If things get too calm, those payouts could shrink. You have to understand these risks.
But after weighing all of it, the performance, the mechanics, and the risks, here's the final verdict. It's a complete 180. My rating is officially upgraded from a skeptical pass to a buy, specifically for investors who are focused on generating income. Ultimately, this whole story about JPQ is a really powerful reminder. We all have our biases, right? Things we just dismiss because of something we saw in the past. But the market doesn't care about our old stories. So the real takeaway here isn't just about one ETF, it's about being humble. And it leaves us all with a pretty important question to think about. What strongly held belief of yours might be worth taking a second look at?